Imagine your trading account hitting zero again for the third time. You're staring at a stark screen, your capital completely gone. A heavy thought settles in. Perhaps this whole trading endeavor just isn't meant for you. But what if I told you the common belief is wrong? The real issue isn't your capability at all. Consider this stark reality. 9 out of 10 new traders typically see their funds vanish within their inaugural year. If you're struggling, you're not alone or flawed. You're part of the vast majority, not unintelligent for trading. What's truly absent is a crucial component, an effective system for market survival. Picture navigating the unpredictable financial markets as an ascent up a treacherous mountain during a fierce storm. You can't command the weather, and the market, like a storm, is completely indifferent to your efforts or aspirations. But here's the good news. While you can't control the market, you can manage your safety gear, your route, and your composure under pressure. In the coming minutes, we'll delve into these crucial elements. This isn't about complex indicators, but about forging a robust system for enduring presence in trading. So, if 90% falter, is it due to insufficient knowledge or tools? Surprisingly, the answer is quite the opposite of what you might expect. Let's uncover the 3 distinct trader archetypes who, despite their differences, all end up losing out. First, we have the strategy collector. This individual dives into countless methodologies, gaining fragmented knowledge about many, but truly mastering none of them. They incessantly switch tactics, declaring, "This didn't work, I'll try that," acting more like collectors of strategies than actual traders. Next, the high-stakes gambler is convinced a setup is a sure thing. They often declare, "I'm going all in," risking half their account on one trade. When the market inevitably moves against their bold wager, their entire trading capital can be wiped out in just one day. Despite their unwavering belief in a trade, these individuals completely overlook the vital aspect of risk management. The third type is the emotional wreck, who begins their trading day with a clear, disciplined strategy. They resolve to execute only those trades that demonstrate a high probability of success. However, a single losing trade quickly sparks frustration, leading them to pursue impulsive revenge trades. This spiral continues with further losses, pushing them into an emotional state where they simply try to retaliate against the market. Consequently, by the day's close, their trading account is utterly depleted. What's striking is that all 3 of these trader types possess significant knowledge, often mastering technical analysis. They've dedicated time to learning, yet they all lack one crucial component: a coherent, overarching system. It's like attempting to scale a treacherous mountain during a storm without essential gear like a safety rope, a map, or mental preparedness. But this fundamental deficiency is precisely what we are now going to address and transform. We're introducing a comprehensive framework designed to revolutionize your approach, which I've termed the 3M survival system. This system comprises 3 interconnected pillars, engineered to ensure your endurance and success in unpredictable market conditions. The first pillar is money management, which you should envision as your indispensable protective shield. This acts as your primary defense, safeguarding you from devastating losses, as a single poor trade can otherwise obliterate your capital. These 3 pillars, however, must always function in unison. A strong money management strategy without a clear methodology will protect your capital but won't generate profits. Conversely, possessing a robust trading strategy but lacking mental discipline will inevitably lead to self-sabotage, undermining all your efforts. And even with mental fortitude, neglecting proper risk management means a single misstep can instantly wipe out your entire trading journey. Think of it like scaling a treacherous mountain. You absolutely need your safety equipment, a reliable map, and unwavering composure for success. While this aspect of money management seems straightforward, many traders regrettably overlook its importance until it's too late to recover. Therefore, the golden rule is to never risk more than 1 to 2% of your total account equity on any single trade you undertake. Consider an account with $10,000. If you risk just 1% per trade, that's $100, which allows for significant resilience. Even after enduring a painful streak of 10 consecutive losses, you would still retain $9,000, leaving ample room to recover and continue trading. Now, imagine a different scenario where you risk 10% per trade, equating to $1,000 for each position. In this case, just 7 consecutive losing trades would completely deplete your account, forcing you out of the market entirely. This stark comparison clearly illustrates the profound difference between merely surviving a rough patch and facing total financial extinction. Employing small risks per trade is your key to enduring inevitable losing streaks, which are a certainty in trading, not an anomaly. To calculate your precise position size, simply divide the dollar amount you're willing to risk by the distance to your stop loss in dollars. Firstly, always set your stop loss before entering a trade and never adjust it further away. Secondly, resist the urge to go all in, as no trade is ever guaranteed. Thirdly, avoid increasing your position size immediately after a winning streak. Maintain consistency until you've proven your trading edge over at least 50 trades. Your capital is safeguarded by your shield, as preserving it remains the paramount objective in trading. Without this essential protection, you simply cannot continue to participate in the market. Next, let's consider your map, which represents your comprehensive trading methodology. This is your decision-making framework, designed to answer 4 crucial questions, starting with, when do you initiate a trade? The goal isn't to trade when the chart merely looks interesting, but when you identify a high-probability setup guided by a checklist. For instance, my checklist includes confirming higher timeframe trend alignment, identifying key support/resistance levels, verifying volume confirmation, and ensuring a minimum 1 to 2 risk-to-reward ratio. If any of these conditions are not met, then no trade should be executed. The second question is about your stop-loss placement, which isn't arbitrary but marks your invalidation point. It's where you acknowledge, if the price reaches this level, my analysis was incorrect and I must close the position. Position it beyond a significant price point and never adjust it once placed. Thirdly, you must determine your take-profit target before entry, not impulsively when profits are accruing and emotions run high. Plan your exit in advance, set it, and then step away. The fourth and most vital question is, when should you do nothing? A staggering 80% of the time, you should refrain from trading. If there's no clear setup, a news event is pending, or you feel emotional, simply do not trade. Patience is your ultimate advantage. Many traders lose money not from poor trades, but from making unnecessary ones, and your map helps you stay disciplined and avoid dangerous situations. However, even with your shield and map, you'll falter if your mind breaks. This brings us to your internal referee, the crucial element of psychology. Beyond external tools, traders often face internal battles. 4 common psychological pitfalls frequently undermine success, and we'll explore each one along with its remedy. The first trap is exiting trades too soon. Imagine you've gained a modest amount, say $50, and despite the trade moving favorably, fear creeps in. What if it reverses? I should lock in profits now. You close the position, only to watch it surge another $500 without you. The solution? establish your profit target before entering the trade, then simply step away from your screen. Next, we encounter the pitfall of clinging to losing trades. You're down $200, your stop loss is imminent, yet a hopeful thought arises. It's bound to recover. Just a little more time. This leads to repeatedly moving your stop loss further away, transforming a small loss into a significant $800 deficit. The remedy is strict, non-negotiable stop losses. When hit, you exit immediately. Accepting minor losses is, paradoxically, a form of winning. The third trap involves overconfidence after a string of victories. I'm unstoppable. Let's double my position. This euphoric feeling can lead to taking an oversized trade that quickly turns against you, erasing all your recent gains. Remember, euphoria can be as detrimental as fear. To counter this, implement a daily profit ceiling. Once reached, your trading day is over. Maintain a consistent position size, irrespective of your recent performance. Finally, there's revenge trading. After a $500 loss, anger and frustration boil over, compelling you to think, I'm getting that money back right now. You impulsively enter another trade, driven purely by emotion without any proper plan or setup, often leading to an even greater loss of $1,000. At this point, you're no longer trading the market, but your own feelings. The straightforward solution: if you suffer 2 consecutive losses, power down your computer. Step away entirely for 24 hours to reset your mindset. Your internal referee acts as a crucial disciplinarian, blowing the whistle the moment you're tempted to violate your own trading rules. It's about prioritizing rules over fleeting emotions and system over rash impulses. Now, let's observe how all 3 pillars of our system integrate. Consider a common daily scenario. Bitcoin is surging, up 5.8% in just 4 hours. Social media erupts with cries of "to the moon" and urgent warnings not to miss out. You feel that undeniable pull, the intense fear of missing out, or FOMO. Without the 3M system, your emotions seize control, whispering, "I must get in now. This rally is happening without me." You plunge in, lacking a clear method or money management, convinced of an obvious win only to buy the peak. Without the guidance of the 3M system, your inner voice screams, "I absolutely have to enter now. This surge is leaving me behind." Lacking any defined method or checklist, you impulsively dive in, neglecting proper money management, convinced this obvious win requires a large stake. Inevitably, the price reverses sharply, confirming you bought at the absolute peak. Your stop loss is triggered and your account suffers significant damage. The financial hit is severe, leaving you not only with depleted capital, but also profoundly emotionally drained and disheartened. However, with the 3M system in place, your inner referee immediately intervenes, signaling a pause and demanding a review of your established rules. You consult your trading methodology, treating it as a map, to meticulously verify if the current market setup aligns with your predefined criteria. The first check reveals the trend is parabolic, a clear warning sign, not a confirmation of a healthy, sustainable move. Next, you realize you'd be entering at a resistance level, not a supportive one, which immediately raises a critical red flag. While volume is present, it appears climactic, often indicating the market is reaching exhaustion rather than beginning a sustained rally. Finally, the risk-to-reward ratio is abysmal. Entering near the highs offers a terrible potential return for the risk involved. Your methodology unequivocally dictates no trade. You wisely refrain from entering the market, trusting your system over impulse. Just 30 minutes later, the price indeed reverses, liquidating all those who succumbed to the fear of missing out. You, however, remain calm, your capital intact, patiently awaiting a genuinely favorable trading opportunity that meets your strict criteria. This illustrates the true strength of the 3M system. It doesn't guarantee every win, but it masterfully helps you avoid costly, ill-advised trades. Preserving capital by sidestepping poor decisions is far more crucial than chasing every potential big win. Now, let's apply this framework to a live chart. Upon reviewing the chart, you confirm the first criterion. The price has reached a crucial support zone that has proven resilient on multiple past occasions, forming a clear double bottom pattern. Next, the third criterion, volume confirmation, is also met. You observe a bullish divergence where the price makes lower lows while trading volume decreases, a classic indicator of an impending reversal. Finally, the fourth criterion, your risk-to-reward ratio, is excellent. You can risk 30 pips to potentially gain 90 pips, a favorable 1-to-3 ratio. All conditions are satisfied, signaling a valid trading opportunity. With the trade validated, you proceed to step 2, precise money management. Assuming a $5,000 account, your strict 1.5% risk rule means you're prepared to risk no more than $75 on this single trade. Knowing your stop loss will be 30 pips below the support, you calculate the appropriate position size. Dividing your $75 risk by the dollar value of those 30 pips, you determine a safe position of 0.25 lots. This careful calculation ensures that even if the trade doesn't go your way, your capital exposure is limited to just 1.5%. Your financial shield is firmly in place, protecting your trading account. Step 3 addresses the psychological aspect, pre-planning every detail. Before even considering executing, you set your limit order at the support level and place your stop loss exactly 30 pips below. This stop loss marks your absolute invalidation point. If the price hits it, your analysis was incorrect, and there's no room for emotional adjustment. Your take profit is also predetermined 90 pips above. With all parameters meticulously set, you embrace a set-it-and-forget-it approach. You won't be glued to the screen reacting to every tick because you trust your system to execute the plan. The critical takeaway is that following this robust process, with your capital protected and rules enforced, matters more than the outcome of any single trade. It's how you ensure long-term survival and an enduring edge. Now, it's crucial to establish realistic expectations for this framework. It won't deliver instant riches, nor will it transform a small sum into a fortune overnight or buy you a luxury car by Christmas. What it will provide is far more valuable: capital preservation, consistent survival in the market, and a solid foundation upon which to steadily build your trading success. In the initial 3 months, expect to hover around break-even, possibly slightly up or down as you diligently learn, forge discipline, and rigorously test the system's application. Between months 4 and 6, you should begin to observe small yet consistent profits. While not spectacular, perhaps 5% to 10% account growth, this progress will be steady and reliably repeatable. This framework guarantees your trading longevity, safeguarding capital, and establishing a solid foundation for growth. It's vital to set clear, achievable expectations. For the initial 3 months, anticipate hovering around break-even, possibly with minor gains or losses. This period is for refining your learning and thoroughly testing the system. Between months 4 and 6, expect to see modest yet reliable profits. While perhaps 5 to 10% account growth isn't extravagant, this progress will be consistent and repeatable. As you move into months 7 through 12, your confidence will naturally build and your trading advantage will sharpen. This allows for sustainable, controlled account expansion. From year 2 onwards, with proven consistency, you can strategically consider scaling up your trading operations. Apply the same system to a larger account. Remember, trading is a marathon, not a sprint. Many approach it with reckless speed, exhausting their capital and failing early in the race. Those who succeed understand the need to pace themselves, building their skills and capital deliberately. They always prioritize protection. If instant wealth is your goal, trading isn't for you. But for a genuine skill generating income for decades, the 3M framework is your starting point. Let's reiterate this core principle. Prioritize survival above all else, and consistent profits will naturally follow. Now, let's consider your immediate next actions and briefly reflect on the journey we've covered together. You once faced blown accounts, confusion, and self-doubt, questioning your ability. Understand your struggles weren't personal failings, but simply a lack of a defined system. You now possess the 3M framework, your money management shield preserving capital, your methodology map guiding decisions, and your psychology referee enforcing discipline. Be sure to subscribe to this channel and leave a comment below. Share your biggest trading challenge, be it money management, psychology, or strategy adherence. I read every single one. Remember, most traders fail due to lacking a system. You now possess one. The crucial question is whether you will truly implement it. For while markets are brutal, survival is possible. Raise your shield, consult your map, and trust your referee. Remember, survive first, profit will follow. I look forward to seeing you in the next video. Stay disciplined.